All right, welcome to the Loan Officer Training Series with the Mortgage Calculator. We will get started here in just a moment. Just give us a second to go live on all the different platforms here. We appreciate everybody tuning in nice and early. We put the chat up on the screen there. Feel free to drop a comment in the chat as you tune in. And we'll get into it here in a moment. All right. See here. All right, looks like we're live on all the different platforms, so we will go ahead and get it started here. We'll take the chat off the screen for now, but go ahead and drop your comments or questions in the chat as we go through here. So, welcome everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender specializing in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening on this show is at 7 p.m. Eastern is a new loan officer training topic, and we go pretty in-depth into them. And tonight we're going to be talking about how to structure a manufactured home loan. So Jose, with 28 years of experience as a loan officer and a realtor, has done his fair share of these, and so he will break it down for us. So, Jose, if you're ready, let's talk about structuring manufactured home loans.
All right, great topic for today, especially here at the Mortgage Calculator, because not only do we do your basic cookie cutter manufactured home loans that you can get out there in agency, but we also have non QM manufactured home options, even for DSCR, right? Pretty cool stuff. So let's get right into our presentation on how to structure a manufactured home. I'll give you guys all the details, and I'm sure you'll be reaching out to us because I know there's some manufactured home loans out there they just didn't know they could do what we're going to tell you tonight that is possible. So let's go with the basics first, right? What exactly is a manufactured home? Now, this is a very important point because we get a lot of misunderstanding out there in the lending world, people confusing a manufactured home with a mobile home, right? That phrase is used interchangeably too often. And unfortunately, if you reach out to me and you say, "Can you lend on a mobile home?" Right? I'm going to tell you, no, that's a chattel loan. That's not a real estate loan. So you'd have to get. That's like similar to getting a loan on a car. If it's a mobile home, right? It's a moving target. It's not permanently attached to real property. Mobile homes are mobile homes, right? They're either a mobile home that somebody's paying for, they may own it, but they're in some kind of a rental lot, right? They pay a lot fee. That's not a manufactured home. And also, a manufactured home is not a modular home. If you're confusing a manufactured home with a modular home, you're leaving money on the table because a modular home is going to be underwritten the same way as a stick built, as they like to say, or site built home. The only thing that could disqualify a modular home is if the modular home is too unique, right? If that modular home looks like your regular everyday home, no problem. However, the modular home is all weird looking, you may have a problem, like it's some kind of a modular home or something like that. You may have a problem because then it's too unique of a property. So that's the basic stuff. So a manufactured home officially is a factory built, right? They're built in the factory. They usually come in two pieces. A factory built dwelling unit built after June 15th, 1976, very important date, which is on a permanent chassis and attached to a permanent foundation system to the land, right? The land. An affidavit of a fixture, and you can usually get that from the title company. An affidavit of a fixture is required to document that the structure is now permanently attached to the land and that it has now transitioned from being a trailer with a vehicle title to real property with a folio number and a deed, right? You can look it up in the tax records and you can find it there. It's going to be permanently attached to the land. It is together with the land, right? That's one unit. You can't buy the manufactured home without also buying the land. You can't buy the land without also buying the manufactured home that it sits on. The manufactured home can be a single wide or a double wide. Now, I mentioned manufactured after June 15, 1976, because if it was built prior to June 15, 1976, it is not eligible for all the standard programs that we're discussing today. And as I mentioned already, the manufactured home is attached to real property and not on a rental lot nor a leasehold. By leasehold, I'm talking about a land lease, right? So if you got a normally we can do condo where the building is on a land lease. We can do a single family home where the structure is on a land lease. And the only thing on those is that the term of the loan cannot be longer than the current term that's left on the land lease. However, if it's a manufactured home, that option no longer exists. So let me give you some specifics, right? Some specifics on to a manufactured home that is going to help you, right, structure your deals. So on a manufactured home, the appraisal is completed on a 1004C, as in Charlie form. So the regular appraisal is a 1004. The manufactured home is a 1004C. Fannie and Freddie both state in their guidelines, right, in the basic guidelines there for the conventional loans, that the minimum size allowable is 400 square feet of gross living area and 12 feet wide. But beware, because many investors and lenders add their own overlays to increase the minimum required size. I can guarantee you it's not 400 feet. Numbers I've been seeing more commonplace are like 1,100 feet. But again, check the overlays of whatever conduit you're submitting your manufactured home loan to, and you can confirm if there's any overlays there that have been added. Real importantly here, FHA, USDA, and VA require a structural engineer's report on all manufactured homes. And I underline there, bold, whatever you want to put, highlight all, because every single FHA, USDA, and VA loan is required to have a structural engineer's report where they're going to confirm the condition of the foundation mainly, and any other components that on the manufactured home. Fannie and Freddie are only going to require this report if the property inspection or the appraisal uncover a condition related issue. Now, beware that the cost of this report is usually $600 and up, and it needs to be disclosed on the loan estimate for the FHA, USDA, and VA. And I would probably disclose it on the loan estimate of the conventional loans as well, and tell the customer I'm putting this on there because we may need it. And if we don't need it, you're not going to be charged for it. That way, if it comes up, you're not going to have a tolerance cure. Now, you may have a tolerance cure for the amount, depending what amount you put, but just beware. Specifically on FHA, USDA, and VA, if you do not put it in your initial LE, you are going to have a tolerance cure for that amount. And if it's a conventional loan, you can still redisclose it if the appraiser notes, hey, you got possible foundation issues, I recommend an inspection. That's when you have to disclose the extra cost, not when the customer pays for it. The affidavit of a fixture is required to show the date that the manufactured home was permanently installed in its current location. Its current location being the piece of land that's associated with the manufactured home that allows it to transition from being a simple trailer to now being a manufactured home. With that being said, the manufactured home cannot be moved from its originally installed location, or it will not be eligible for the standard financing programs that we're talking about today. There may be some outlier program, one of these pseudo almost hard money type options that allows it, but not what we're talking about today. Homes built from 1990 onward, in other words, newer, qualified for the conventional Fannie and Freddie Manufactured Home Advantage Program, which offers lower rates than standard conventional options. I've usually found it to be about a point to a point and a quarter cheaper in pricing for the Manufactured Home Advantage compared to regular conventional financing. Now, I'm going to cover this a little bit more in some slides coming up, but the only option for an investment, and this is why I was saying this is a great topic for the mortgage calculator, right? Because the only option for an investment manufactured home loan is through non-QM. That's it. As agency is only primary and second home, and USDA and VA is primary only. So we can do those full doc, bank statement, P&L, DSCR. So let's talk a little bit about some more, details here, right? The HUD, decal plates, and data plates. What exactly are we talking about there? Well, the decal plates are certification labels. They're metal. That's why they call them plates, and they're riveted to each corner of the property. So the manufactured home comes to the site in two pieces, usually. Each piece in a corner is going to have a HUD certification plate called the decal plate, certifying that the manufactured home meets federal construction standards for manufactured homes. That's really important. It's also going to certify proof of compliance with construction and safety standards. Now, this decal plate, which is located on both ends of the manufactured home, both need to be legible and photographed by the appraiser. Why is that an issue? Because a lot of times they're painted over. Maybe a piece of siding was replaced and it was the one that had the plate. Maybe it's all scratched up, and you can't read it anymore. It's not legible. And the HUD data plate is located inside the unit. I've yet to be able to locate one, right? I think they're like maybe inside some kind of a cabinet, in a pantry, in a closet, wherever they put it. I guess unless you have the original paperwork that says where it is, the appraisers can never find it. And that's important because that HUD data plate also needs to be photographed by the appraiser. So if these data plates are not legible or not located, whatever may be the reason that the appraiser cannot take a picture of it, then you need to obtain verification letters from ibts.org to confirm, right, if the manufactured home was built according to HUD requirements. These verification letters, and they're going to need to be ordered, and they have a cost. The cost can be anywhere from $150 to $250 per letter. The higher cost if you order it as a rush. And their cost needs to be disclosed on the initial loan application disclosures. I would definitely do that. Because what happens if the appraiser can't find it? Then you need to be on point. Read the appraisal the day you get the appraisal. Look through it, realize that there's no verification plate that they were able to photograph, and then you would immediately have to disclose that amount. So to avoid that, I would highly recommend that you just disclose that amount. Tell your customer you may need it, you may not, because if you do need it, and most of the times they are needed, and you don't request it within 3 days of receiving the appraisal and realizing that it doesn't have it, it's going to be a tolerance cure if you disclose it when you get the invoice that the customer paid, because by then it's probably been 2 weeks or a week since the appraisal was received, then you're going to have a tolerance cure. Please note that to be able to order these verification letters, you're going to need the serial number of the manufactured home. You're going to need that. So that serial number should be available somewhere. Without it, it's impossible, because when you go to ibts.org, you're going to enter the serial, you're going to put in the order with the serial number, and that's how they go to the database, search by serial number, and that's how they will provide you with the verification letters for the original data plate and decals. Please note, the loan will not close if the decal and data plate information cannot be verified. That's critical, because that's how they're gonna verify that everything was built according to HUD certifications. So let's talk about now options on the different loan types. So with our conventional loans, which is Fannie Mae and Freddie Mac, we're looking at 97% max LTV for a home ready Fannie Mae option and a home possible Freddie Mac option, which is great. 97. Now you're not going to get the 97. I don't know. I don't think you're going to get it on a regular 3%, but definitely on the home ready and home possible, because those programs are affordable loan products, and we realize the reason the manufactured homes are the rage in the real estate industry right now is because they're affordable. They're more affordable. There is an affordability crisis in real estate right now, combined with an inventory crisis. So manufactured homes is definitely an outlet to remedy this situation. So Freddie and Fannie and their affordable products let you go up to 97%. Keep in mind, DU, as always, will set the minimum credit score requirements. Also mentioned earlier, most investors and lenders will only allow double wide due to overlays. So if you got a single wide, look really hard in your eligible and ineligible properties in the guidelines to make sure that they don't add an overlay for single wides. Co-ops and condos are ineligible as manufactured homes. So if you got a manufactured home sitting in a location that has a home, a condo designation, not going to happen. Same for co-ops. There's a little specific detail there, but those of you thinking about Fannie Mae home style renovation, manufactured home is not eligible for Fannie Mae home style renovation, but it is eligible for Freddie Mac. So that's a good option. Now, like I was mentioning, Freddie permits adding an ADU to a manufactured home as part of their guidelines if the ADU is stick built. Fannie Mae does not permit the addition of an ADU to a manufactured home. I already mentioned about MH Advantage offering lower rates, and real important to note here, cash out on a conventional loan for manufactured homes is only allowed for primary residence, and it's usually going to have some reduced LTVs. So if your loan option is going to be FHA, USDA, and VA, then you're looking at on FHA max 96.5% LTV, USDA is the usual 100%, and VA is the usual 100%. Best news is there are not any loan level price adjustments for manufactured homes with these loan options. That's great news, because in Fannie and Freddie, there are loan level price adjustments. That's why we have the manufactured home advantage option to try to help a little bit with that. And as always, on VA, FHA, and USDA, it's primary homes only. And I did already mention that FHA, USDA, and VA do require a structural engineer's report. So don't have a tolerance cure, be aware of the structural engineer's report. And our last option here is our non-QM option. Now, this is where it gets exciting, because there aren't a lot of people that really know that we have these options exist. That's why we do these shows, let you know that you can do manufactured homes and non-QMs as primary, second homes, and investments for purchase, rate and term, and cash outs. As we saw, Fannie and Freddie, cash outs is primary only. Non-QM, second home and investment. Now, we are going to have a little, reduced LTVs. So you're looking at max 70% for full doc and the same max 70% for bank statements, the same max 70% LTV for profit and loss. But best news, 70% LTV for DSCR purchase and 65% is the LTV and the cash out. So those max 70% are all for purchases. Cash out, 65% LTV. So I'm sure there's some excited investors out there right now that just realize that they can cash out their manufactured home with the DSCR. So now you know who to call. Call the mortgage calculator, and we'll quickly set you up with one of our loan consultants to help you with your manufactured home loan. So I'm really looking forward to helping any of you out there structure their manufactured home loan for their purchase, rate and term, or cash out refi.
All right. I don't actually see any questions. There is one question here. I guess you pretty much went over it though, right? How do we structure a refinance for manufactured homes?
Yeah, I think we covered pretty much all of them there.
Yeah, that was asked early on before I think you got into it. So I think we are good to go then. I don't see any other questions. So I think we can go ahead and wrap it up here. A couple of very important points there. So make sure when you're doing one of these loans, you pay attention to what Jose was talking about. Here comes a question in here. Take this question. How about one-time closed construction loans on manufactured homes? Do we have anybody to do that besides AFR?
Well, that's an option, one-time close is possible on manufactured homes, but like I was mentioning earlier, we have to look at the overlays. So, Fannie and Freddie says you can do it. Not every investor out there will accept loans of that type, so it is a limited product offering, but it is possible.
All right. All right, let's go ahead and wrap it up. Remember, we do this, Tuesdays, Wednesdays, and now Thursdays. We just started doing so Thursdays, 7 p.m. Eastern. So we will be here tomorrow with a new training topic. We appreciate everybody tuning in. We'll see you tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Thanks, everybody.